silver could be on the verge of a move that most of the market won't recognize until it's already well underway. And the setup today looks very similar to past periods, where silver lagged quietly before accelerating violently. Right now, silver is trading around the mid-$80 per ounce range after a sharp recent surge, while gold continues to hold firm above $4,600, signaling sustained demand for monetary protection. This relationship matters. Historically, silver does not lead major monetary moves. It follows gold. But when it follows, it does so with leverage. The gold-to-silver ratio, which spent long stretches elevated during periods of uncertainty, is now compressing, a pattern that has previously preceded some of silver's most aggressive upside phases. At the same time, real interest rates remain unstable. Even if nominal rates stay high, inflation-adjusted yields are struggling to provide confidence, especially as debt servicing costs rise and fiscal pressure increases globally. When real yields become volatile rather than decisively positive, silver tends to benefit disproportionately because it sits at the intersection of monetary hedging and industrial demand. Unlike gold, which is held primarily for protection, silver is consumed. It is critical for solar panels, electronics, EV infrastructure, and advanced manufacturing, sectors that continue to expand even as growth slows elsewhere. Supply, however, is not keeping pace. Mine production growth has been relatively flat, while above-ground inventories have been drawn down over recent years. This creates a fragile balance where even modest increases in investment demand can produce outsized price moves. Rates play a crucial role here, as markets begin to price the possibility that policy rates cannot remain restrictive indefinitely without breaking something. Whether in credit markets, housing, or government finances, capital starts positioning ahead of that realization. Silver often reacts before official rate cuts arrive, not after, because it is forward-looking and highly sensitive to liquidity expectations. Add to this the fact that silver's market is significantly smaller and thinner than gold's, and the ingredients for a sharp repricing are already in place. The danger for most investors is that silver rarely offers a clean entry. It tends to move slowly, appear uninteresting, and then accelerate rapidly once key psychological levels are breached. By the time mainstream attention returns, volatility is already elevated and risk is higher. That is why silver explosions often feel sudden, not because they are unpredictable, but because they develop quietly while focus remains elsewhere. Today's combination of elevated gold prices, unstable real rates, tightening physical supply, and growing industrial demand suggests silver may once again be setting up for a move that only becomes obvious after it has already started. What strengthens the case even further is how positioning and market structure around silver remain surprisingly underdeveloped compared to the macro forces building underneath. Despite silver's recent jump into the 80s, participation is still relatively narrow when measured against previous cycles. Large institutional portfolios remain heavily weighted toward gold as the primary hedge, while silver allocations are often treated as secondary, tactical, or optional. This imbalance matters because silver historically delivers its most dramatic moves when capital reallocates, not when fundamentals merely improve. Futures positioning data has often shown that silver rallies begin with skepticism, not enthusiasm. Traders fade early strength, assuming the move is temporary, while long-term investors hesitate due to silver's reputation for volatility. That hesitation creates the fuel. When price holds higher levels despite doubt, forced positioning begins, short covering accelerates, momentum strategies flip long, and physical demand increases as buyers fear higher prices tomorrow. Rates play a central role in this process. Even if central banks delay formal rate cuts, markets trade expectations, not decisions. The moment participants believe that restrictive policy is becoming unsustainable, whether due to rising debt costs, banking stress, or slowing growth, silver begins to price that future liquidity shift. Importantly, silver often reacts before bonds fully reprice, because it is both a monetary signal and a scarce industrial input. Meanwhile, physical premiums tell a story that paper markets often ignore. When investment demand and industrial demand converge, availability tightens quickly. Refining bottlenecks, transport costs, and inventory drawdowns amplify. price moves beyond what futures alone would suggest. This is why silver rarely moves smoothly. It doesn't climb in orderly steps. It gaps, stalls, then surges. Another overlooked factor is psychology. Gold at record highs attracts respect, but silver attracts disbelief. Many participants remain anchored to old price ranges, mentally treating $30, $40, or $50 as expensive, even as the macro environment has radically changed. That anchoring delays participation, allowing early movers to accumulate while broader attention stays elsewhere. Once that psychological barrier breaks, silver tends to overshoot, not because it is irrational, but because it is catching up to years of underpricing relative to monetary expansion and industrial use. This is where the risk-reward shifts quickly. Early stages feel boring and uncertain. Later stages feel chaotic and crowded. The current environment, elevated gold prices, unstable real rates, constrained supply, and cautious positioning, fits the early to middle stage of that historical pattern. Another powerful force building beneath silver's price action is the growing disconnect between paper pricing and physical reality, a gap that tends to widen before major repricing events. On futures exchanges, silver is often treated as a financial instrument, traded in contracts, hedged with algorithms, and influenced by short-term rate expectations. But in the real economy, silver is a consumable input, and once it is used, it is gone. Unlike gold, which largely remains in vaults and can re-enter the market, silver is embedded into products, ranging from solar panels and semiconductors to medical equipment and advanced electronics. This creates a structural difference that becomes critical when demand accelerates. As investment interest increases alongside industrial usage, the market is forced to reconcile two competing realities: paper supply that appears abundant and physical supply that tightens quickly. When that reconciliation happens, price adjustments tend to be abrupt rather than gradual. Rates again sit at the center of this tension. High nominal rates may suppress speculative enthusiasm temporarily, but they also raise financing costs across the supply chain, discouraging new mine investment and expansion. Silver mining is often a byproduct of other metals, meaning supply does not respond directly to price signals the way gold does. Even at higher prices, production cannot ramp quickly. This lag is dangerous in a market as thin as silver's. At the same time, industrial policy around clean energy and electrification continues to support long-term demand regardless of short-term economic cycles. Governments can slow growth, but they cannot easily reverse infrastructure commitments tied to energy transition and technology competitiveness. This creates a baseline level of demand that persists even when sentiment turns cautious. When monetary stress overlays this structural demand, silver becomes a pressure point. The market may ignore it for months, but once the balance tips, reactions are violent. This is why silver explosions often feel disconnected from daily news. The move does not come from a single catalyst. It comes from accumulated strain finally being priced. By the time headlines catch up, physical inventories are already tight. Spreads widen, and price discovery accelerates. The current environment, elevated gold prices, unstable real rates, cautious positioning, and quietly tightening physical supply, suggest that silver may be approaching that inflection. Not tomorrow, not on a specific date, but closer than most expect. And historically, when silver reaches that point, it does not wait for consensus. What makes this stage particularly deceptive is that silver often looks strongest right before most investors dismiss it again, assuming the opportunity has already passed. This is where timing becomes misunderstood. Silver does not require perfect economic conditions to move higher. It requires imbalance. That imbalance can come from rising fiscal stress, uncertainty around rates, or simply the realization that liquidity cannot remain tight forever without causing damage elsewhere. As global debt servicing costs rise and governments face pressure to sustain growth, markets begin to price future easing long before it appears in official policy statements. Silver is extremely sensitive to that forward pricing. Even subtle shifts in expectations around rate ceilings, balance sheet policy, or fiscal accommodation can trigger renewed interest. Unlike equities, which often need earnings confirmation, silver moves on confidence inflection points. At the same time, volatility itself becomes a catalyst. As silver's price starts to move more aggressively, risk managers who previously avoided it begin to re-enter, not because volatility is low, but because volatility is rising. This creates a feedback loop where price movement attracts attention, attention attracts capital, and capital accelerates price. Importantly, this phase rarely feels comfortable. Pullbacks are sharp, headlines swing between enthusiasm and skepticism, and many participants are shaken out repeatedly. That turbulence is not a flaw. It is the mechanism by which silver redistributes ownership from weak hands to strong ones. Rates remain a critical backdrop throughout this process. Even if nominal rates stay elevated, what matters is whether real rates feel restrictive or unstable. When markets sense that stability is eroding, that rates are high but unsustainable, silver tends to respond forcefully. This is why silver often outperforms during periods of transition rather than clarity. The metal thrives in environments where policy direction is uncertain, liquidity is uneven, and confidence is being reassessed. Right now, many of those conditions are quietly aligning. Silver does not need a dramatic headline to explode. It only needs the market to collectively realize that staying underexposed is riskier than tolerating volatility. The deeper takeaway is that silver's most powerful moves rarely begin. When conviction is high, they begin. When conviction is fragmented. And that is exactly the environment forming now. Markets today are caught between competing forces. Elevated interest rates that cannot easily fall, debt levels that cannot easily be serviced, and industrial demand that cannot easily be paused. Silver sits at the intersection of all three. It is sensitive to monetary stress like gold, but unlike gold, it is also embedded in the real economy in ways that make shortages and bottlenecks matter. This combination is what creates asymmetric outcomes. When conditions remain calm, silver underperforms and frustrates. When conditions become strained, silver does not move incrementally. It reprices violently. That violence is not random. It is the result of years of underinvestment, thin inventories, and delayed participation suddenly colliding with urgency. Rates play a final critical role here. Whether policy rates are eventually cut, held, or restructured through balance sheet tools, markets are already grappling with the reality that the current rate regime is not sustainable indefinitely. Even if nominal rates remain elevated, the cost of maintaining them rises over time as debt rolls over and fiscal pressure compounds. Silver does not wait for official announcements to respond to that reality. It reacts when the market collectively senses that something has to give. At that point, traditional valuation frameworks stop working. Price becomes less about fair value and more about availability, positioning, and fear of missing exposure. This is why silver peaks are often extreme and emotionally charged. They are not smooth reflections of fundamentals. They are releases of accumulated imbalance. The danger for most investors is not volatility, it is complacency. Silver spends long periods doing nothing, conditioning participants to ignore it, only to move faster than portfolios can adjust when the shift finally arrives. In that sense, silver explosions are not surprises. They are failures of attention. The current macro backdrop, high debt, unstable real rates, persistent industrial demand, and constrained supply, does not guarantee an immediate breakout, but it does create a narrow window where underexposure becomes increasingly risky. When that realization spreads, silver does not offer polite entry points. It forces participation through price, and by the time the move feels obvious, the quiet phase that made it possible is already over.